The stock market is dropping, headlines are screaming, and one claim keeps spreading fast. That this crash is planned, and that Donald Trump is intentionally triggering it. That's a big accusation. So let's cut through the noise and look at what's actually happening, what's speculation, and what really matters for investors. First, the facts. Markets have been volatile. Major indexes have taken hits. Investors are nervous. The main trigger hasn't been mysterious, it's policy uncertainty, especially around tariffs, trade, and interest rates. When governments introduce aggressive tariffs, markets react immediately. Tariffs raise costs for businesses. Businesses pass those costs to consumers. Profits shrink. Stocks fall. That part isn't controversial. That's basic economics. Now, here's where the theory comes in. Some analysts claim this isn't accidental, that Trump welcomes a market drop because it forces the Federal Reserve to cut interest rates. Lower interest rates do three things. They make borrowing cheaper. They reduce government debt servicing costs. And they eventually push money back into stocks and assets. In theory, that creates a reset, short-term pain, long-term gain. But here's the reality check. No president controls the stock market. No president can precisely plan a crash without risking massive political and economic fallout. Markets are global, emotional, and unpredictable. A real crash hurts retirees, pensions, businesses, and consumer confidence, including voters. If this were a controlled plan, it would be reckless at best. What is real is leverage. Politicians use pressure, not precision. They make aggressive moves knowing markets will react, then use that reaction to push other institutions, like the Federal Reserve. That's not a secret plan. That's political brinkmanship. Now let's talk about the Federal Reserve. The Fed's job is to control inflation and maintain economic stability. When markets fall hard, the Fed pays attention, not because of politicians, but because crashes tighten financial conditions fast. If stocks drop, borrowing slows. If borrowing slows, growth slows. If growth slows too much, rates get cut. That doesn't mean the crash was planned. It means the system is reactive. Here's the part most videos don't tell you. Market downturns happen regularly. On average, a correction happens every 1 to 2 years. A bear market happens roughly every decade. Crashes feel rare, but they're not. What makes this one louder is politics, social media, and fear-driven content. Fear gets clicks. Planned crash gets views. Calm analysis doesn't. So what should investors actually do? First, stop panic selling. Selling during fear locks in losses. Every major crash in history eventually recovered, every single one. Second, understand time horizons. If you need the money in months, volatility matters. If you're investing for years, downturns are normal and often opportunities. Third, separate politics from portfolios. Markets don't care who you voted for. They care about earnings, rates, liquidity, and confidence. Presidents come and go. Markets outlast them all. Now, let's be blunt. Anyone claiming they know this crash was planned is guessing. There's no proof. No documents. No confirmation. What is provable? Tariffs create market stress. Rate cuts often follow downturns. Politicians exploit market reactions. That's it. No master switch. No hidden control room. No guaranteed outcome. If anything, this situation shows how fragile confidence is, not how controlled markets are. So here's the takeaway. This isn't the end of the stock market. It's not a secret demolition. It's volatility amplified by politics and fear. Markets fall. Markets recover. The cycle repeats. If you want to survive and benefit, you stay disciplined, informed, and unemotional. That's how money is made. Everything else is noise.